Hi, everyone. I'm Clyde Bryant, and welcome to episode 11 of the Uptown Experts podcast. I'm sitting here today with Luigi Cirocco, and we're going to be discussing Uptown Asset Management, our newest division.
Hi, Clyde. Hi, everyone. Good to be back. It's been a while. It's been a while since I've been invited on. I wasn't sure if maybe I didn't perform up to par on episode 1 there, and I wasn't getting invited back. But nice to be back on in front of the camera.
Yeah, definitely. We're happy to have you, Lou. And it's we like to say it's quality over quantity. So this
Quality over quantity.
Yeah, of course, right?
Which one am I?
We'll decide that one later. So why don't you? I'm going to hand it over to you today. Why don't you get started?
Yeah. So we're doing things a little bit different today. We're flipping the script. I'm stepping into the hosting chair. I probably should have sat on that side, but I think that chair's custom made for you. And
yeah.
let's face it, I'm not going to fit into that chair if it is. So I'm going to be auditioning for the new Uptown podcast as host. Essentially, is what we're doing here.
I mean, we'll think about maybe a co-host situation. I think maybe.
I prepared. Look at this for people who are listening in their cars. I'm holding cue cards here.
This is new for Luigi.
Yeah, usually I'm very much as you know, I'm very much a let's just wing it and have a real conversation guy. But there's a couple of questions I do need to ask, and I want to make sure I do remember. So we're here to talk about asset management.
Correct.
Yet another, not company, I don't want to call it a company.
It's a division.
Yet another division of Uptown.
Correct.
So first question for you. Very simple, open-ended. Tell me about Uptown Asset Management, if you will.
So Uptown Asset Management is our mortgage administration division. It's in that division where we will provide the Ontario public with the ability to invest in mortgages by utilizing their registered portfolio, RRSPs, TFSAs, LIRAs, RRIFS, that type of thing. They also have the ability to invest in mortgages with funds held in your banking accounts. It's also through Uptown Asset Management that we have the ability to offer, again, the public their Uptown GIC. And it's in partnership with other institutions that we're able to make this all happen.
Okay. I'm going to go off script right away.
Okay.
I had my questions laid out, but I'm going to go off script because of what you said. So you mentioned mortgage administration division. Can you just, for me, for others who aren't so savvy with respect to this world, can you tell the people what is a mortgage administrator?
Uptown Asset Management will act as the mortgage administrator or the company that works with you as the investor and the end borrower. So let's assume there is a mortgage agent, mortgage broker that has a client that needs a mortgage. And here at Uptown Asset Management, we have an investor that is looking to provide lending. And what we'll do is we'll pair the two together.
Okay. You took the words right out of my mouth, pardon me. So you're essentially pairing a broker with an investor.
Correct.
And lending the investor money to that client.
Correct. And through there, or through the asset management division, we are able to collect the necessary payments from the borrower, provide that to the investor in a timely fashion. We provide assistance with contractual obligations, so mortgage commitments, review of mortgage documents, that type of activity, which is something that we do on a daily basis, which makes us professionals. So leverage the professionals to review the necessary documents in order to review the application, the borrower that you are considering lending your money to. And from there, that investment will be made, but in a more secure fashion.
Okay. So how is this different from investing with a bank?
Well, it's very different in that when you invest in an RRSP with any one of the big banks.
Sure. Yeah. So let's say I go into Bank of Montreal.
Yeah.
Have some money, and I say I want to open an RRSP with you guys.
Yeah.
So they typically would just open some sort of account.
Yep.
They tell me what rate I'm going to get as a return. I put my money there, and Hopefully, if things go well, I never have to really worry about it, and it grows.
Yeah, but at
And
the
maybe
banks,
I contribute here and there,
Yeah.
and whatever.
Yeah.
So how is this
how it
different
works.
than that?
Yeah, it's different in that. So a couple points that you made. One, you walk into the bank, you ask them for an RSP account. They'll open the account and they'll say, "Here's your 5% or whatever they're offering now." And like you said, you have the ability to contribute to that RSP over time as it grows, or openly. With the investments that we provide, they're different in that, one, we manage them through a third-party company. And those registered funds are held with that third party. So we come to you, we'd say, "Hey, Lou, you want to invest with us. Open up an account with one of our third parties, and you'll hold your RSP, which will be a self-directed RSP with that third party," which, again, keeps a little bit of an arm's length to give you the true ability to manage that RSP, right? It's not like we can go in and do it on your behalf.
Right.
And so that's the first piece. It puts you in the driver's seat.
Okay.
Second, walking into the bank or any financial institution, they're going to give you probably a lower rate of return than what you would be able to get by investing in mortgages. And whether that's a first mortgage or second mortgage, our returns are generally anywhere between 8 and 12%.
Yep.
As compared to most banking products.
Just due to the nature of the product, the risk involved with it, that sort of thing.
Correct.
Generally is why you're getting a higher rate of return.
Yeah, and people say you take the time or take your capital and invest it in mortgages, it might be risky. And I look at it and I say this: if you take your money and deposit it into the banks, do you actually think the money sits in the bank?
No, of course not. But a lot of people don't know that. Once the money goes into the bank, that's it. They're turning around and they're lending that money out.
Yes,
or
they're investing it. They're doing
using your money to
in
make
order to
money.
make profits. Yes,
correct.
Because they are a deposit-taking institution. So with that in mind and understanding that not to go further down the rabbit hole, but CDIC insurance only gives you coverage up to $100,000.
Yeah.
So if you have more than $100,000 sitting in the bank, are you really covered? Well, the answer is no. Now, if you take that $100,000, $200,000, whatever it is that you have in your RSP, $50,000, and you invest it with us, and we register that $50,000, $100,000 as a mortgage on title, that's security. That's real security. And barring a true, crash in the markets where the house was valued at $1 million and we said we're going to lend to 75% of the value of that home, that's $750,000, your investment is going to be pretty secure. And if we've said that we've lent at $750 and you're making 10%, and there's a huge upside in regards to that investment versus what you might be making at the banks today. So you get security as well as a higher rate.
Yeah, that's a good point. So we're talking about asset management, but they're still lending at the core of all this, right? So
of course.
It's still coupled, your investors' money is still coupled with, I'll say, responsible underwriting. Right. So that if you ever get into a worst case scenario like you referenced there, you've mitigated the risk early on, and really you're looking to prevent any losses whatsoever.
Correct. I mean, the goal behind lending is not to create loss, it's to create wealth. And, one of the things that we do here at Uptown is we leverage our various divisions, as you know, being one of our senior
create
underwriters.
wealth through returns.
Correct.
Not through seizing properties.
No.
Just for the people out there. Well, because there are lenders that, there are some,
lenders.
call them predators. There are predators out there that lend you money knowing you'll never pay, and then they'll be looking to take your house. We're looking to generate revenue
Correct.
and returns for investors in the responsible way. And the bank used to say this to me all the time, is like, we're not in the lending game to own property.
No.
That's not why we lend money.
Absolutely.
It's more of a headache than it's worth, honestly.
Yes.
As you know for sure. But I just felt the need to mention that when we're lending, we're looking to generate returns via, interest, not via having to unfortunately sell a home. Nobody wants to be in that position.
No one ever wants to be in that position. But, that's why, going back to the point where responsible underwriting comes into play, right? And ensuring that when we see a loan, we review that loan in order to find not just the opportunity to lend, but to ensure that we have a solid exit plan. And any time that we lend with assets that are either held through asset management or other divisions that we have here at Uptown, we ensure that there's a true exit, ensuring that the borrower has the ability to repay that loan in a timely fashion. And maybe that is 1 or 2 years, and that's okay. But there should be a true exit plan that is put together that allows you, or pardon me, the borrower, to be able to move on.
So let me ask you a question related to that. How involved is your investor when determining whether their money goes out in the form of a loan? Are they heavily involved, passive? Is it their choice?
Yeah.
How involved would they be?
It really does come down to choice, to answer your question. We are, we're big believers here at Uptown that, education. Education is one of the most important things when it comes to investing. So we like to take the opportunity to educate our investors, let them know exactly what's going on in regards to that loan that's potentially being put together. But at the same time, most of our investors don't actually practice mortgages. They practice in whatever they do because they're regular people, just like me and you.
Right.
So we take the opportunity to provide them with the necessary information and educate them, but a lot of them, many of them, and probably most in the future, will continue to leave it to us to say, yes, this loan makes sense, and I don't necessarily need to, they need to understand the intricacies of it because they're investing, but the choice is really up to them to say, yes, I want to know, be the one to rubber stamp it, or I'm saying yes, Clyde, you now need to say yes. So in the order in which it would happen, ultimately.
And I would imagine there might be some individuals who maybe when it's their first time, they feel like they want to be more involved because it's sort of new to them. And then as you do a few deals with them and with their money, they may now be more passive because they've seen how it works. They trust your expertise with respect to where their money is going to ultimately go out to in the form of a loan. Do you find that happens? That after a few, they kind of just, give me the highlights, but you kind of make the decision.
And I mean, at the end of the day, an investor ultimately still needs to know what's going on with the deal, where their money's being invested, and they need to sign off on all the required documents. It's their loan. It's their investment. They're in charge. It is self-directed, as opposed to the product, with other financial institutions. The money goes into some magical pot that most people have no clue. If I were to ask them, what's your money invested in? They say, well, I don't know. Some diversified this or some, TSX
Absolutely
that, right? Yeah. Versus, here at Uptown, I'm going to take the opportunity to say, hey, Luigi, this mortgage is going to be registered on, 222 somewhere street at the rate of 10%, and your proportionate share of this investment is $100,000 from your RRSP. So now you can count on, I know I'm making 10% because it's a fixed rate. I know where my asset is being registered, and I know in the event of something happening, here's the mitigation that's been, or I should say, the plan that's been put in place in order to make sure that I get my money back.
Right. Yeah, and tax sheltered. So
yes.
That's an awesome option. I worked for the bank for 15 years, and you'd be surprised how little even bankers know about these sorts of options, right? Because banks just simply don't have these offerings.
Correct. No, I love the banks. I say this all the time, and I don't like talking bad about the banks. That's not what we're here to do, but we're here to educate. And, educating means letting people know about all the options that are available to them, and making sure that they are the ones to choose based on all the information that's out there. That when you don't know, you can't make the right choice. That's really what it comes down to, right? But once you know that there's A, B, and C as an option, you can choose the right one for you. That's where I was going with this, pardon me.
That's a good segue. So let me jump in there. It is RRSP season now as we record this. There's a lot of people looking for options on where to put their money who is this for? Who would you say, not necessarily just an RSP, because there's other offerings, but of course, who is this type of investment for?
I would say this type of investment is really for that medium risk investor, someone that's, invested before. You're not going to come to us and say, hey, Clyde, I want to start an RSP.
So I've got my first dollar. I'm looking to invest it. We're not for you.
We're not for you.
We're not for you.
You need to have established an RSP account. There really isn't a minimum, so to speak, but I always say it needs to be a number that makes sense. Remember, people are coming to us for mortgages. First position, second position, mortgages. So, I like to say to most of my investors, if you have an RSP of, maybe 40,000, 50,000 or more, then come talk to us, because now we can show you options or provide you options that will allow you to grow your RSP at a much quicker pace and, go from there.
Yeah, and you guys offer, I don't know, I'm saying you guys, I'm part of the company, but we offer LIRA, LRSP, as I've personally learned. So some clients might have, locked in accounts that they're just assuming that's it. Like I'll see you when I'm 65.
Correct.
But you have options for that as well. That can be moved over and lent out in the form of mortgages as well.
Yeah, and because it's a locked-in account, there is so much that you can do with it.
And your time horizon's
exactly
long as well, right?
Yeah. So, you look at it and say, leverage, someone like yourself, for example, and myself as an example, 40-something years old, another 20 plus years to retirement. And, you can earn at the interest rate of, maybe 5% at the banks, or you can earn at a rate of, 10% with us. And, if you look at it and, we talk about the rule of compounding interest before, how long is it going to take your money to double, right? So if all of a sudden we're giving you a higher rate of return and it's 10%, 12%, whatever that might be, 6 years, 7 years, your money's going to double.
Yeah, well, 7.2 years.
7.2 years, exactly.
At 10%.
Yeah, that's three doubling periods. If you came to us with $100,000, it's going to grow 3 times. Compound 3 times, I should say.
Yeah. Okay. What else do I want to hit on here? GICs. Okay. So this, even though I'm in the biz, tell me how a GIC works in this vehicle.
Yeah, so it's a traditional GIC. Just like, someone comes to us through our mortgage division, our mortgage brokerage division, and says, hey, Clyde, I need a mortgage. We can take that to, any one of the banks, any one of our broker channel lenders and give them a mortgage. Well, the Uptown GIC is no different. We would take a look at the amounts that our potential investor is looking to invest in a GIC, and it can be a cashable GIC or a locked-in GIC. And we take a look at what the various institutions are offering in terms of return and provide them with options, whether it's whoever it is. It doesn't really matter.
So a GIC investment is not lent out in a mortgage.
No, it's a classic GIC, just like you would get at any one of your banking institutions. The real difference is you walk into a bank to get a GIC, you might get maybe they're offering 4.5%, maybe probably less now, to be honest, right? Maybe 4% on a GIC. The product that we're going to be able to give you might have a little bit of a premium attached to it in order to make it a little bit more attractive.
And how are you able to do that? Is it because when I go to my bank, I only have my bank's offerings available to me, whereas we will have the ability to invest in a GIC with numerous offerings, so we can sort of pick which institution has the better return. We want to take it to, essentially.
Yes, of course. Yeah. I mean, people often forget if they bank with, any one of the banks, Royal, TD, CIBC, it doesn't matter. You walk in, you say, hey, I have my money, I want to put an RSP. They're going to sell you the TD RSP or the CIBC RSP. They're not going to turn around and say, hey, Luigi, our RSP is offering 3.8%, but I know if you walk down the street and went to Royal, they're going to give you 4%. They're not going to do that.
No, if you've
right?
worked at a bank, you You have targets you need to hit.
Exactly. So they're going to take in the money because that was your request, and they're going to invest it for you. The difference is if you come to us, we're going to look and we're going to say, hey, Luigi, no problem. Let's take a look and see the best rate that we can get for you based on the product that you're asking us for. And then we'll take a look at all the various companies that give us the ability to invest, and we'll present one to you. And, 9 times out of 10, we're probably going to have a slightly higher rate.
And you said no minimum amount.
No, it's a GIC.
So, sorry, let me rephrase the question. So thank you for that. But for an RRSP, TFSA, everything else under the asset management suite of products,
correct?
Is there a minimum amount?
There's no, as I said, there's no hard and fast minimum, but it should make sense. If someone has an RRSP of $20,000 and that's the number that they have, great. We can manage it. But is it harder to put it out as a mortgage? Yes, because it's $20,000. Sure.
Yeah, and you would disclose that up front that, I'm happy to take your money in. These might be the challenges with an amount of this size.
Nature. Yes, but on the other side, this is where planning and conversation comes in. We're here for the investor. We're here for our clients. And with that, what we would do is we would say, let's look at the timing to ensure that when we do have a mortgage, that mortgage investment, that fits your lending criteria, your risk that you're willing to take on, then we'll give you a call and we'll try to pair that investment timeline with the transfer in of your RSP. And now it works for everybody.
And on the flip side, I would imagine you'd have a similar discussion if somebody wants to give you a lot of money. It's,
of course.
Number one, is this suitable?
Correct. Always comes down to
your customer profile. Mm-hmm. And number two, I would think you would disclose the same sort of risks that maybe I can't put your money out in the form of a loan
right
all
away
at the same time. Correct. Or right away, because it's a large
sum.
A larger amount than a lot of people are seeking.
Mm-hmm. Yeah, because when you look at the product, and I go back to my statement, is somewhere between 8 and 12% is what your return is going to be, right? Now, when you look at the product, again, because it is a mortgage, we have to go through, mortgage application processes, making sure that the deal actually fits, making sure that, we get in all the required documents, appraisals, and do our due diligence. And, there's only a certain number of loans that we look at every month. And of course, the number continues to grow, but there is always going to be downtime when an RSP or registered funds are going to sit. There's always going to be a time where registered funds are going to sit. And for that period of time, whether it's a day, 2, a month, maybe even 2, you have to understand, because this is a mortgage investment, you won't be earning during that time. But on the flip side, let me just take a sip here. I apologize.
Well, they have to understand what they're getting into, right?
Correct.
I'm sure the other side of that is, do you really want us to get your money out right away? Because then that starts to get into that territory of, are we putting it out in loans that are maybe we shouldn't be?
Correct.
Are we taking more risks than we're comfortable taking? So I know your philosophy is you'd rather have the money sit.
Correct.
For the right
deal.
Loan,
correct. For the right
rather
loan.
Than just to, this guy, I haven't moved his money. Let's get it out.
No.
But then if there's no quality, if there's not a quality deal to get it out to, then what? Then what are we doing, right?
Exactly, yeah. And, that's, again, goes back to the underwriting, the due diligence, and our philosophy, right? And to your point, I would rather have, the money sit for a month or 2, or even 3 if we needed to get you into the right loan. But when we get that mortgage investment out, we'll get it into a product that is probably going to give you a return of 10, 11, 12%. Just being realistic in this interest rate environment. So now you're receiving a return that is significantly higher than what you would get with your traditional, investment from a lending institution, from your traditional investment from your banking institution. So even though that money was sitting for a period of time, not making anything, when you average out what you're going to make with your RSP investment with us compared to your financial institution, you should end up ahead.
Good, very good. Anything else you want to tell the people about Uptown Asset Management?
Well, as I said, we're a mortgage administration division or a mortgage administration company. Our goal is to look to administer mortgages, which means we have the ability to underwrite, collect, and remit payments. And whether that's for an individual or for a company that already has a significant mortgage investments under management, and they're finding it difficult to manage those mortgage investments, it's something that we could also help with. So we're not just for the individual, we're for large corporations as well.
Okay. When are we open for business?
We're open for business yesterday,
Okay.
2 days ago, a week ago.
I know that,
right?
but I'm asking, as a good host should, for the people, that we're ready to go.
We're ready to go. Yeah, we've been ready to go for a while.
It's been a process, eh?
Yeah, of course. Like any good thing, right? You want to make sure that not just getting it open, but getting it open, making sure it's running properly before you really turn it on.
Yeah, exactly. There is that risk of rolling something out, being a little too gung ho, and then you can't cope. You collapse, right? Yeah. And that doesn't bode well for service.
No. So as I said, we're ready. We're ready to go. We've been open and operating. We have some significant dollars already under management, and we are looking to continue to grow. Yeah.
February 29th,
RRSP
right?
deadline.
RRSP deadline. So I don't even want to say it because it sounds weird coming from me. Call Clyde. But call him. He's a busy man, but he's going to answer the phone no matter what.
Always.
Last question. Where did you get those shoes? Because, did you?
I love my shoes.
Did you rob? Remember the Legion of Doom and WWF? Did you steal those from?
No, but those guys had. They had it. I think they were ahead of their time, right? But I'm a shoe guy, so I'm always gonna have something funny going on.
Ahead of their time.
Yeah, ahead of their time, man. Those guys were wearing spikes before spikes were a thing.
Those look like they're behind the times. Those are shoes that people needed years ago when they needed to break rocks and things.
Yeah, well,
they probably cost more than my whole wardrobe, I'm sure. But
you said it, not me.
Anyway, how did I do hosting duties?
Not bad. We'll think about the next time we have you on. That was every 10 episodes, I think.
Yeah,
so we'll see you on episode 22 or something.
My passion is really my future podcast that I'm going to do with our young Evan here, Friends versus Seinfeld. We're going to discuss which is the better show.
Oh, that's going to be interesting.
I'm not going to tell you which one I'm a fan of. Excuse me. Sorry, Michelle, distracted me. So thanks for having me back on. I hope to come back on in future as a guest.
Yes, we have a lot to discuss.
Talk about stuff that excites me. Not that this doesn't excite me, but I feel like I'm very much like your public right now. Like I'm learning. These questions are. Maybe we can tell the people they're actual questions that I had when you were talking to me about this initially, and I requested to sit down with you and learn more about this. So I figure if I have those questions, people would have those questions, and that's where the idea of flipping the script and maybe having me ask the questions came from.
Exactly.
So thank you for having me back.
And thanks.
And I've been enjoying the podcast. I'm one of your devoted listeners.
Thank you very much.
Every episode, Eddie, Paul, Pando, Mike, who I don't know Mike, but
Mike was great.
Enjoyed that episode. So keep it up.
Thank you very much. Well, I guess that's how we'll wrap this one up. So
can I do the outro?
Dare you?
Uptown Experts out.
He tried.